You know, when a company drops its quarterly earnings, the market pays attention. But sometimes it doesn't just pay attention, it absolutely roars. And that is exactly what happened with Everus Construction Group, or ECG. So today, we're going to deconstruct their frankly massive Q2 2025 earnings report and the incredible market reaction that followed. Okay, let's dive right in. And wow, what a reaction it was. This number you're looking at, that's the 30-day return on ECG's stock right after their announcement, a jump of almost 35%. That isn't just a good day, folks. That's a huge signal that something fundamental is going on with this business, and it definitely needs a closer look. And you can bet the analyst community took notice. D.A. Davidson really hit the nail on the head here, pointing to these powerful underlying trends. This wasn't some fluke. This was a company that is just firing on all cylinders, and it seems to be perfectly positioned in the market. So, what did everybody see that got them so incredibly excited? All right, let's start by decoding the numbers. What exactly was in this report that sent the stock to the moon? First things first, revenue. A 31% year-over-year increase, hitting a record $921.5 million. I mean, this was the first time in the company's entire history they broke the $900 million mark in one quarter. And they didn't just beat analyst expectations, they totally smashed them. But this is the number that really turned heads. An earnings per share beat of roughly 61%. You know, when Wall Street is expecting one thing, and you come out and deliver something this much better, it just screams incredible efficiency and profitability. It's the kind of surprise that makes investors scramble to get a piece of the action. And this chart just shows you the sheer scale of that beat. We're looking at what's called non-GAAP earnings per share. It's just a way companies look at their core profitability without some of the one-off accounting stuff. So analysts were modeling around 64 cents. ECG came in and delivered $1.03. That huge gap you see on the screen, that is pure, unadulterated upside, and it's a testament to what the company called solid execution. So the big question is, can they keep this going? Well, this number offers a pretty convincing answer. $3 billion. That's their total backlog, all the contracted work they have lined up but haven't finished yet. It's up 24% from last year and basically gives investors a super clear look into future revenue. It's a promise of a lot more work to come. Okay, so we've seen the incredible results, but how? How did they actually pull this off? Let's get into the growth engine and take a look at the two key parts of the business that really drove this amazing performance. Now, what's really fascinating here is the story this slide tells. You see, while the transmission and distribution business grew a respectable 3%, the absolute star of the show was the electrical and mechanical segment. It just exploded with 42% growth. And the reason? Well, according to the company, it's all about the surging data center and cloud infrastructure demand. But it's not just about being in the right market at the right time. ECG has a secret weapon, so to speak, off-site prefabrication. Basically, this means they're building huge parts of their projects in a controlled factory, not out in the mud and rain of a typical construction site. You can almost think of it like building with giant, high-tech Legos. And this strategy gives them a massive, massive edge. In the factory, they can control quality and production with incredible precision. This cuts down on the chaos at the actual job site, which makes the whole project safer, faster, and way more efficient. Like CEO Jeff Seed said, prefab certainly does help with our companies being able to execute. It also helps with us getting work. Okay, so let's zoom out for a second, because ECG isn't just running a tight ship internally, they are also perfectly positioned to ride some huge long-term waves in the industry. This is the big picture that has all those analysts so excited. These are what the pros call secular tailwinds. These are trends so big they can lift an entire industry for years, maybe even decades. We're talking about the insane demand for data centers, the urgent need to upgrade America's old power grid, and the massive build-out of renewable energy. ECG is right at the heart of all three. They aren't just in a good business, they're in the businesses of the future. So, after a quarter this huge, the obvious question is, what's next? Well, the company gave a pretty clear signal by significantly raising its forecast for the rest of the year. Just take a look at this updated forecast. They boosted their revenue target by about $300 million. And they raised their EBITDA forecast, which is just a measure of a company's overall financial performance, by $35 million. This isn't just a minor adjustment, it's a huge statement of confidence about their momentum going forward. But, it wasn't all just champagne and fireworks. The CFO, Max Marcy, pumped the brakes just a little, injecting a dose of realism. He pointed out that with so many brand new, massive projects starting up and some work getting pulled forward into the first half, it makes predicting the exact workflow for the next few quarters a little tricky. And what's really important to understand here is that management is framing these challenges as logistical, not fundamental. This is not a demand problem, it's a "we're growing so fast we can barely keep up" problem. It's about the timing of when these enormous new jobs will really hit full speed, which they're hinting might be more of a 2026 story. And that really leaves us with the big question, doesn't it? When you're sitting on a $3 billion backlog, you're riding these massive industry tailwinds, and you've just put a blockbuster quarter on the board, is a timing issue really a headwind? Or is it just a small speed bump on what looks like a very, very long runway for growth?